start this. All right. Good morning. Today is July 12th, and we're going to continue with the presentation with the project, financial ratio analysis project. We are going to do something else for the moment, for a few minutes until we have everyone in, and then we'll continue with analysis. So for today, we're going to finish the analysis, and then the balance of the time, I want you guys to work on the assignments and see if I can get at least 2 of them today. Or let's see how that's because you're going to use the balance of the time for that purpose. Okay? All right. So before we go back to the presentations, I want to go to this. We already went through the different types of analysis, and we talked about the horizontal analysis, if you remember, trend analysis. We talked about the vertical analysis, and then we are in the middle of the financial ratio analysis, and as you can see, these are the profit margin and asset turnover. Those are the profitability measures. So if we go back to the chapter in the book, page let's see, go back to chapter 16, 15, and chapter 16, page 'Okay. I think we did okay, we are, I think, up to the last one. We got up to the long-term solvency. We didn't do that one, but we did the ones before that, correct?
The long-term what?
The long-term solvency. It was the last one we did.
No, the last thing we did was return on equity ratio.
Yeah, that was a profitability. Okay, we did liquidity.
Yeah, that was a profitability rate.
And we did that was the last of the profitability ratio. And then long-term solvency, the coming one. Long-term solvency is the coming one. Before we go to that, until the majority are here, before we get to that one, I want to talk about one more that is not included in the project, okay, which is evaluating operating assets. You know, operating assets. How do you manage your assets? On page 677. How do you manage, or how do you tell if your assets are performing well? If they are effective or not effective, your assets. And are they most of the times broke, or you keep fixing them, or they are generating revenue properly and effectively? How can you tell? One of those things is, the way you can tell is inventory turnover. Okay, inventory turnover. What does that mean, inventory turnover?
How quickly are you going through your inventory?
What do you mean by that?
Like, how quickly are you selling your inventory and ordering more?
Yes, sir, exactly. How many circles you do? What I mean by that, every circle is what you're saying exactly. You buy the merchandise, you mark it up, you put it on the shelf, you sell it. That's one circle. Then you do that again and again and again. Yeah. So how many? The more of those circles are, the more that your inventory is efficient. Yeah. Inventory management is efficient. So in order to check on the inventory turnover, the formula for that is, like as you can see, cost of goods sold divided by, let's just say inventory. You don't have to put average inventory. If you put average inventory, that means you're going to take inventory at the beginning of the year and inventory at the end of the year and divide by 2. So we just say inventory. If we talk about 2015, we just use 2015 inventory, like that, all right? So that would tell us how efficient is our inventory management. And if you look at the financial statements that we were getting the numbers from earlier, which page was those? The ones we were looking at earlier.
668 and 669.
Page 668 and 669. Oh, I'm on page 680. 668 and page 669. Okay, so let's get the numbers from there. Cost of goods sold is what? If you look, is this is a pro forma statement. Not those ones. There's other ones. Yeah, not these ones. We look at the one on page 665 and page 666. 665 and 60. Cost of goods sold for, let's say, 2011. On page 666. Okay. Cost of goods sold is 49.3, and divide that by inventory. The inventory is, you're going to get it from the balance sheet. So the inventory is, if you look at the page before that, and you will see inventory for 2011 is 965.8. 965.8. You see that? Yeah. We're not doing average inventory, we just do one for that specific year. Yeah.
We get 5.12.
That means, what does that mean? That means you have 5 point what you said?
5.1.
Okay, that means you have 5 circles. You do 5 times you buy your inventory, you mark it, you put it in the shelf, and you sell it 5 times. Now, is that good or bad?
That's good.
Well, it depends on what kind of business you are in.
Oh, yeah.
And now, if you are a car dealer, for example, if you are a car dealer, is that good or bad that you empty your parking lot, all your inventory, then you bring another shipment, then you pay?
Yeah, that's good.
For a car dealer, yes, I think it's good for a car dealer. If you do it 5 times, that means like about twice, every 2 months, almost, you sell your inventory complete. That's not bad. But what if you are in a grocery business?
Oh, that's not good.
Yeah. So it depends on what kind of business you are
Stuff go bad.
in. Yeah.
Because stuff go bad a lot faster it goes. So if you don't sell it by a certain time, it goes down as waste, which is going to be a loss.
Mm-hmm. So, okay, it depends on what kind of business. Okay, that's one ratio, inventory turnover. And then also you have a days inventory on hand. Days inventory on hand. And that means, so we said 5 times, correct? So how many days does it take each time? How many days does it take each time? So that's what days inventory on hand means.
Oh,
Yeah, how many? Of course, we wanted the lower, the better. The lower, the better. So if we do it 5 times a year, and the year has 365 days, correct? And you divide by 5. 365 divided by 5.
Divided by 5.1.
Uh-huh. You don't need the 1.1, yeah.
Oh, just 5 then?
Yeah.
Okay. That's 73 days.
It takes 73 days to sell your inventory. That's a lot of time.
Yeah.
Now, when you think of it, yeah.
That's like 2.5 months.
Yes. How often do your inventory you replace?
We do a store order like really we do a store order like every week.
So you do it on a weekly basis.
We run out of a lot of stuff like as far as like tobacco, people come in and buy cigarettes and sell it to a dip, whatever. Then
Do you sell alcohol?
Yes, sir.
And
Yeah.
is that a hot item?
Oh yeah. People even try to come and buy it on Sunday mornings and all that.
Oof.
Yeah, but we're not allowed to sell alcohol till 12 p.m. on Sundays anyway. So
12 p.m. in the afternoon?
yeah, because of the blue law restriction.
Ah, okay. I wish Smith County stayed as a dry county.
I guess you could still call it dry because it doesn't sell liquor. You know what I'm saying? It just sells beer.
But no, they sell alcohol too.
That's what I mean, but it's not the hard stuff.
It is the hard stuff.
Nah.
Yeah. I've seen stores that they sell hard stuff in Tyler.
What?
Yes. Look even in the supermarket. Look at Super One. There's a whole Brookshire.
You talking about like Bud Light and all that?
No, I'm talking about beer. Wine and all of that stuff.
Wine. I'm talking about liquor like Hennessy and Patron and all that stuff like that. They don't sell that in Tyler.
Yes, they
I
do.
could have sworn they had some of this stuff in Walmart.
Nah.
Yes, they do.
Nah, Tyler.
Brother Benny, where do you live? You live in Tyler?
Yes.
That means you've never been in those places yet.
Man, I go shopping.
There are all kinds. Go to the liquor section. Oh, God forbid, I don't want to even think of it
I'm
yet.
not even old enough to drink, so I don't want to go there.
Yeah, if you go into the liquor section just to look, and you will see all kinds of liquors there. All kinds. The champagne, the tequila, everything.
Yeah.
Yeah, it's hard alcohol.
Oh.
Yes, sir. Mhm.
It's all just sold on some shelves at Walmart.
They must have just had that.
Nah, they been having it because it's people that I hate that people at the time be getting they live.
They drive about 30 minutes out.
Or go to the bootleg.
You want to pay $50 for a little bottle?
Anyway, but they all did I give you the
Yeah, you get
chapter
one.
16?
You get one.
Give you chapter 16. And find it. So that's the difference between inventory turnover and days inventory on hand. Okay? So that's one way of evaluating the operation of your assets. If it's efficient operation or not. Yeah. Okay, and then also another way is your receivable turnover. Your receivable turnover. How is your collection policy? When you are collecting your receivable, are you efficient in that, or you having difficulties, or you writing off lots of your receivable? So the same thing. That you will have a receivable turnover is equal to your net sales over accounts receivable. Net sales over accounts receivable. And of course, this one, the same thing. You want to collect your receivable as much as you can. As much as you can. So if you can collect it every week, that would be really good. And if you look at your net sales on page 666, which is your revenues, okay, for 2011 is 11,700, and you divide that by your accounts receivable from the balance sheet.
You want to put the
You can leave it. Yeah. You don't have to do the average account receivable. Just do the receivable for 2011, and that will give you how many times you sell your inventory.
It's 386.
Okay, so
I got 30.3.
how much?
30.3.
That means you collect your this business collect the receivable 31 times a year. That's not bad. I mean, like almost more than 2 times a month.
You know, once every 2 weeks.
Yeah. How often do you collect your receivable?
I don't even know.
Well, all of those your credit sales.
Oh well.
Or they probably don't know. The main office is the one who probably does the collection.
Yeah.
And do you have your own credit card, your business?
Yeah, we do. Yeah, we do, but only none of us are allowed to use.
People use it to buy stuff too in the store.
Oh yeah, like only if it's necessary. Like say, like last time it had to be used was like when it was real snowy outside. The roads were real slippery. We had to go buy some like sand for our walkways and all that. That's when last time we had to use a company credit card. But other than that, I can't tell you that.
The rest of it is they probably use their Visa, MasterCard, and all of that. Yeah, but it's still sales on credit.
Oh yeah.
Still sales on credit. So I'm assuming at your place like yours, they do the collections every month. So they will collect their receivable probably 12 times a year on a monthly basis. Yeah.
That's not.
Yeah. Well, of course, the collection is on a continuous basis
Oh yeah.
because somebody's 30 days is different from the other person's 30 days and the other. So probably you collect receivable on a daily basis almost, the main office.
Oh yeah.
Okay, so that's how you do receivables, and then also you have days sales uncollected. How many days it takes to do the collection? The same thing. You divide 365 days by the number of times you collect, and that shows you how many times you collect, how many days it takes each time.
Take 11 days.
Yeah, that's, when we say 3 times a month almost, yeah,
That's good.
for that business. Yeah, that's not bad. Okay, now I think let's go back to our analysis and get your company out, your company financial statements, get those out. And let's do long-term solvency. Oh, let me see if I can get to. Let me myself get to. Where is the email? Let me get to the email and staff email. TXC20. And let me go to sent items, ratio analysis, and open. Okay, enable editing. I emailed that to everyone yesterday.
Okay.
Yeah, check your email. I emailed you that. Okay, so we were up to here. This is slide number 5. So what is long-term solvency?
Long-term solvency.
What does solvent mean? That's when the business is in debt.
Oh.
And if you can survive, how long can you survive? That's in other words.
Oh, okay.
How long? I mean, if you pay your debt, your long-term debt and all that, that means you can
Survive.
As long as you pay your debt, you are
Good.
good. Yeah. Let me see where they are. Those. It's a financial risk. Another name for it is financial risk. See if you can see it in the book. Here on page 675.
Ledbetter and Goodrich said it down the street.
Huh?
Ledbetter and Goodrich said it down the street. Ledbetter and Goodrich, they said it down the street.
They're down the street.
Yeah, so they're on.
Here.
No.
Okay. And then.
Oh no, they're down the street from the school.
Okay.
Yeah, I know.
Anyway, we will just have to go and do it. And the first, so it's the ability of the business to survive. That's what when you want to define long-term, you're going to say the ability of the business to survive on the long run. Okay, and debt to equity ratio, and I'm asking for one ratio in this regard. Debt to equity ratio. Ask them to listen.
Okay.
Yeah. Debt to equity ratio is equal to total liabilities divided by stockholders' equity. Total liabilities divided by stockholders' equity. So look at your. Now, what does that mean? Why are we comparing liabilities to stockholders' equity? That is the structure of your capital. Some of the capital is okay. Some of the capital is brought in by the stockholder, and some of the capital came through liabilities.
Yeah.
Okay, so we want a ratio that has more equity than liability.
Yeah.
So that's what we're looking at here. The structure of the capital, what percentage of it is debt, and what percentage of it is from the owners. We just started. We were doing something else. Yeah.
Yes, sir.
So get your statement out. While you are getting your statement, let me give me some water here.
So total liability divided by stockholders' equity. Depends on your work.
Hell nah.
Since you gonna do Miss Class and do it.
I ain't gonna miss class. I'm gonna do it because he said he'll give us time to work on our assignment after we finish it. So I'm just about to finish it up. Oh shit.
My subscription ended last night for my Word and all my Office shit.
Damn.
I got off from work.
I was about to type it up. Your subscription.
I was so tired from work, I fell asleep at the table.
I was like, oh my god.
I fell asleep at the table with my tablet on the chair.
All right. This is slide number 5. I emailed it to everyone
Yes, sir.
yesterday. So look at your total liabilities for you. Which one are you using, 18 or 17?
18.
Okay, look at this is your income statement. You're going to look at your balance sheet. Okay, your total liabilities are, long-term debt, cumulative,
See, that's not.
long-term debt. So you got to add your current liabilities plus your long-term liability, and that will be your total liabilities. You got to add the 78,521 plus all of these. That will be your total liabilities. Don't you have one for total liabilities?
They had the equity. They had the total equity and the total.
No, but here you can do it. See, you got to add your total, your current, plus your long term, that one, plus that, plus that. Yeah.
Okay,
So
let me see
yeah.
all this other stuff right here.
No, just up to here.
Oh, okay.
Yeah. You got to add your long term debt and as well as your current debt. So yours,
Yeah, right.
Reverend Darren, is going to be.
Yeah, I'm dividing right now.
Wait a minute.
You said
Yeah,
total-
where's your total liability? Okay, show me your total liability.
total liability, right?
Yeah, he has it in a nice figure. He's correct. He has a total liability, yeah.
But the long-term solvency is the ability for
And
the
then
ability of the
total
company.
stockholders' equity.
Not that. Stockholders' equity is this one.
Yeah.
This is both liabilities
Ability of the
and
company to
stockholders.
survive.
So this-
So you need the
Yeah,
252.
That's
You're
right.
correct.
Uh-huh.
You're correct. The brother there is doing fine on his own. He's getting the correct ones.
Fine.
But he's lucky. His statement has total liabilities in it.
Oh, okay.
Yeah.
Wait a minute, not all statements have total liability?
Nah,
Huh?
mine
Mine
don't.
don't.
Mine don't either.
But you got see, you can figure those out.
Oh yeah, I got it right
So
here.
that's what I get.
You got that makes sense. Yeah, that makes sense.
1.4.
I'll tell you what that means once you figure it out. Yeah.
Okay, so that's right.
Or what you could do if I were you, and to you too also, Brother Bailey. Here's what you could do. You could do this total minus equity. That will leave you your total liability. See, because this one is total liabilities and equity, correct?
Minus the equity. it'll give
Yeah.
you the
If you
total
take the
liability.
equity out of it,
I just did
Yeah.
it to take my answer, so yeah, I know what you're talking about.
yeah. So that will come. That's an easier way to do it. Yeah.
Same thing. I got like 3.6.
3.6. Okay. What did you get on yours?
1.58.
So take a look at this. Which one is larger, the equity or the liabilities?
The liability.
Liabilities.
Liabilities more. That means you have the biggest portion of your capital structure is coming from liabilities. And again, you can say good and bad. It depends on the circumstances of the business. Yeah. Okay, but you can check from other areas. The other areas like the liquidity, the profitability, and those can give you a good example about how the business is doing. Yeah, but that means that this business can it survive? I think it's okay. Yeah. So you think your liabilities are larger? I doubt that. Okay, so let me. Your total equity is 80. Okay, let me see. Do this for me. 204. 522 minus 80, 822. Okay, what do you get? 123. But see, that's your equity. No, sorry, that's your.
My liabilities.
Yeah, and your equity is 88, 22. Okay. Yeah, your liabilities are more than your equity. Yeah.
Mine is a lot. Mine is way more.
Okay, which business is yours? The Coca-Cola?
company.
Okay. Yeah.
Now my liabilities were like 68 billion, and my stockholders' equity was only 18 billion. So that's why I got 3.6 from. So we're real high.
Oh yeah, that's a lot of debt.
Yeah.
Lots of debt. Yeah, but still surviving.
Oh yeah, it's Coca-Cola.
Yeah,
We
it's
always-
still surviving.
Like I said, Coca-Cola too big to fail. So.
Yeah. But yeah, it's all over the world.
Yeah, it's too
Every
big to fail.
every part of the world you will see.
Coca-Cola.
You find Coca-Cola, yeah. Anyway, so this is the debt to equity ratio, and I'll only ask for one ratio, okay? And
long-term solvency, that's the ability of the company
to survive on the long run. Yeah.
to survive in the long run.
Yes, sir. There is other. Now that's it for. There's another ratio. That we have to include. I
I
didn't
know you
include.
wanted 7 slides because there's gonna be one more ratio that you want at the conclusion.
No, there's one more ratio. If you look at the syllabus, then I didn't put it here. Look at the syllabus for a second. I think there is also one more ratio, interest coverage ratio. Interest coverage ratio, correct? Debt to equity ratio, and then
Oh, for the long-term solvency,
Yeah.
the interest coverage ratio.
yeah. So let me add this one to the slide. Add this one to the slide, guys. Okay. Add that interest coverage ratio. Yeah, we got to include this one. Okay, interest coverage ratio. All right, and interest coverage ratio. All right, and it is equal to income before taxes. First you define, and then you're going to do interest coverage ratio is equal to your net income, income before taxes, income before taxes, plus,
Interest expense
yes,
divided by interest expense.
plus interest expense, the whole thing divided by interest expense. Okay, and then you make your comments. Then you make your comments. Okay, on the business ability to survive. Yeah. So look at your income before. First of all, what does that mean? Interest coverage ratio. It means your ability to pay off your interest on your debt.
Measure the degree of protection creditors have from default on interest payments.
In simple words, can you pay the interest on your loans? Now, sometimes if you have bonds or mortgages, the interest on your mortgage can reach up to $4,000 or $5,000 on your home a year. Some people can't pay that, and they end up repossessing the house. Whoever is the one who is offering you the mortgage, if you can't pay interest, they will take your house from you. Yeah, they will repossess it. So, business is the same. If they have bonds payable, they have to pay interest on the bond on regular basis. You remember, we said interest payments could be quarterly or yearly or semi-annually. All right. So look at.
It says income from continuing operations before income taxes.
Yes. Okay. Yes, that's it. Income from continuing operations before income tax. Okay.
6742.
Yeah. Did you find yours?
This right here say my interest income. It just got one.
Before that. Before that. Okay, this is your operating. That's still income. Income before. Hey, that's the one for
Yeah, I
tax.
got that one.
Yeah. See, it says income before taxes.
Yeah. No,
Which
what
is
about the interest?
This plus your interest. Do you have interest?
See interest right here.
Yes, sir.
All the way down. Yeah, so-
That's your net interest. That's the one you need. Yeah.
Okay.
Did you get your interest, Reverend?
I'm getting income before taxes.
Mine was 84.
Okay. Got your income before tax?
Yeah, that's right here.
Okay.
64.
All right. Go ahead and do that. Minus. Oh, sorry. Plus.
Nah.
Yeah.
Oh, we do that.
Plus your interest expense.
Oh. Plus.
Oh crap.
All right.
No, I didn't put in the wrong numbers. I just thought over.
Okay. And then divide by your interest expense. I emailed this one to everyone yesterday. The complete one. We just have one ratio missing. I just added in interest coverage ratio. On the long-term solvency, slide number 5.
That's weird.
Well,
My number only went up like
15.
Wait a minute.
Oh, that's too much.
Wait a minute. So it's income before taxes plus
Plus interest expense
divided by the
divided by interest expense.
So it's gonna be the same. Basically divided by the same number.
Yeah, by the same number.
That's
That makes sense.
mine is 9.01, so I'm just gonna be.
I'll tell you once you figure it out. How much? What's your answer, Reverend?
Alright, so
Okay, get your financial statements out.
Yeah. I don't have mine.
What did you do?
It's at home.
I hope you did not close it.
Nah, I know exactly where it's at. I just didn't have this folder last time I was in class.
Oh, you brought another folder.
And I ain't thinking about it till now. So
Okay.
I need to get it together.
We are on long-term solvency,
Okay.
and we started with debt to equity ratio.
I got you. I think
Yeah.
what we do.
Okay, go ahead and do
It's the
that.
same thing we did yesterday, right?
Yeah, we got up to here. We didn't do that.
it's about 5.3.
That makes sense, yeah.
So you add and then you divide.
So you take your total liabilities and divide it by your total equity. That first ratio, debt to equity ratio. And then second ratio is interest coverage ratio.
That's what I was talking about.
2 ratios, yeah. And that's equal to your income before tax plus interest expense divided by interest expense, the same number.
Got you.
Now that ratio means how many times, I mean your ability to pay off your the interest on your loan, on your debt. So as long as it's 1 and above is good. So if you have 5 or you have 9, or that means you can pay it 5 times, not just 1 time, which is really good. Over 1, it means it's really good. So that's not bad. And you have enough money to pay off your interest, not just 1 time, 9 times, yeah. So that's not bad. Okay, so those are the 2 ratios in the syllabus for long-term solvency.
So what about the equity? Do we have to do receivable and inventory? too?
No, just these.
Oh.
Just these.
Okay.
But whatever you have on the, just the ratios on the syllabus.
Like that's what I'm saying, because we didn't go over these
Total
yesterday.
stock.
Oh,
Yeah,
yes,
the
we did. Yeah.
receivable
We'll go
and
back to those in a minute. Yeah.
Okay.
Yeah, I didn't see those.
Yeah.
Guys, Ali,
Yes, sir.
where's total stockholder equity?
Look at your balance sheet.
That's what I mean.
Yeah.
I was so damn tired. My feet was hurting.
Is the balance sheet? Or is the-
Feet are
No, that's not. See, that's sales and the.
I don't even have my tablet up. Where was it? I'm just.
What's on the balance sheet?
Yeah, starting from here. Yeah, from here. So
You
you
got it like 3, 5,
okay? Equity is your total.
I can do 5, that's like
You're doing
25.
17.
25 cents.
This one, yeah.
And then you're gonna add up that, I mean, you're gonna divide that with the total.
With total stockholder, total liabilities first.
I already got that.
Yeah, divided by total equity. Yeah.
Yeah.
Okay, that's one ratio. And then the second ratio is your
Income.
interest coverage. Interest coverage ratio. See that interest coverage ratio there?
Ah, I see, yeah.
That's
Number
number
the time
2.
we get out of here. But then it's very
Yeah, that makes sense. Lots of sense. Okay, do the next one, interest coverage ratio, is your income before taxes, which is
Go back to slide one, because we got the two more ratios on slide one. For the liquidity, the
This
receivable
one.
turnover, and the
well,
inventory.
you have it nicely done. Good.
Yeah.
Income
It's
before
right there, the first one.
income tax.
The root, not the root.
That's exactly what it's asking for.
Excuse me.
Listen, 251, 619 divided by your interest expense. Here's your interest expense.
Oh yeah, I ain't these two.
Alright, your interest 14,544. Okay. What did you get? 17, not bad. As the best one, 17 times. They can pay their interest 17 times. Nike.
Oh, yes.
No, something.
No, yeah, it's, I'm like,
Oh, Sony, sorry.
Sony Digital.
See, if I want to buy a TV, I'm planning on buying a Sony one. Sony or Sony on Christmas time. I'm planning on buying one, a big screen.
You ain't
you don't
gonna
get it mounted, yeah?
I'm gonna get buku big screens me.
No,
Black
not-
Friday.
Not that big. I already have one.
They be over
I have it for about 15 years now. And that's enough, you
You don't need
know.
a new one?
60 inches for about 300.
Yeah, that's a big, you don't need a new one?
So,
Nah, you don't.
yeah, I'm going to get the new one, yeah.
You are?
Yeah.
Okay.
Hopefully at Christmas time, if I save enough money, I will buy one, you know. That's the plan. After I get my tax refund, yeah.
You will.
Oh, yeah.
Okay. You got your let's go back to which one is that we were doing? Liquidity, guys. Let's go back to liquidity ratios. Liquidity ratios. Which is the first second slide. See, I only put current ratio and a quick ratio. We have two more ratios to go also. Add two more ratios to that. Okay, the first one is receivable turnover. Add to that, and that's my fault. Okay, receivable turnover, because that's in the syllabus. So we're gonna add receivable. Before we elaborate on the overall liquidity, receivable turnover, ratio. Okay, first you define, okay, and then receivable turnover ratio, okay, is equal to your net sales
divided by your accounts receivable.
Divided by accounts receivable. Okay, so look at your net sales. Go back to liquidity. Go back to that. So have a special sheet. Say, make a note to yourself to go back to liquidity. And we're going to add two more ratios. So your net sales.
That's the RC.
Yeah, return on
Receivable.
receivable. receivable turnover, sir. Receivable turnover ratio. So your net income is, I'm sorry, your net sales. Your net sales. Now you go to your income statement. Yeah. That's your income statement. Find your net sales.
Count receivable.
Is that?
I see net receivables.
Is it
Net
the
sales divided by your.
I see net receivables.
That's fine.
Okay.
What's the difference between receivable and net receivable? You should know that by now.
So receivables and net receivables.
Uh-huh. Remember last time when we, in accounting 1, when we talked about management of accounts receivable, and you have sales returns and allowances.
Oh yeah, that equation.
So, well, I'm sorry, inventory, sorry, I'm talking about accounts receivable, bad debt. Remember the bad debt expense or allowance for doubtful accounts? So your receivable minus allowance for doubtful account is equal to your net receivable. That's it. But if you don't have it in here, that means that's your net receivable, whatever you have here.
Well, my net revenue is
That's fine, that's it.
That's the same thing.
Mhm,
That's
yeah.
what I was thinking.
That's it.
35.
Net sales.
Accounts receivable, you gonna find that on the balance sheet.
That's too much, this answer.
Oh, that's too much.
Yes, sir. Okay, let me. So for 2018, take that number. That number, first one, 495, divide by.
That's what I had.
Huh?
That's the number I had.
Okay, divided by your accounts receivable. Divided by this one.
Well, I got trade accounts receivable, less allowances.
Okay, now see what you get. Huh?
My accounts receivable, would it be like this one right here? The trade accounts receivable.
Yes, sir. That's it.
Okay.
Yeah. That's it. What did you come up?
20.
That makes sense. 20.
I got 88.
That makes sense too. Which company is this? Walmart?
Yes, sir.
Yeah, I'm not surprised then. Because Walmart has all kinds of merchandise, and so they almost collect on a daily basis. I mean, they collect their receivable 88 times a year. That's not bad.
I
Not
got
bad.
9.7.
That makes better sense, yeah. Mhm.
Okay. You know what I'm saying? A little balling over here.
So receivable turnover is how efficient are you in collecting your receivables?
Thank you.
Okay, so that means you collected, how many times you came up with? 20 times a year. They collect the receivable, yeah. So then we have one more ratio, which is
The inventory turnover.
inventory turnover. Of course, the more, the better. Okay, the more you collect your receivable, the better it is. Okay, same thing with inventory turnover. Ratio. Oops. Turnover. Turnover. Ratio. Cares. And that's equal to your
Cost of goods sold divided by,
cost of goods sold
divided by your inventory.
divided by inventory. Cost of goods sold divided by your inventory. So cost of goods sold is in the income statement and your inventory is in the balance sheet. which is your cost of sales. If you have your cost of sales,
I got cost of goods sold.
yeah, that's it. Cost of sales.
I got cost. They gave me the cost of goods sold, right?
Good, very good. Yeah. What do you have in yours? Your statement.
I don't know why I feel like it's some cows.
I got that waiter app yesterday.
Brother Ledbetter, are you listening to the music or are you with us?
Not really. But
Oh, you be
have
having
to
people
be
bring
with
you
us if you
food?
want that bread.
I got you. I don't have no paper, so like,
So you can
I know what it is.
you can observe your friend. Okay, here is your cost of, let me see,
Cost of sales right there.
yeah, cost of sales.
I got 4.99, so I'm just gonna round it up to 5.
Huh?
I got 4.99, so I'm just gonna round it up to 5.
Okay.
Yeah, I know it's
It
not.
makes sense. I mean, the number is logical number. Divide that by your inventory.
Yeah. No, that's what I got. That's my final number.
Ah, okay, I'm talking to him.
Oh, okay. I was like, look.
Look for you in the balance sheet. Your inventory in the balance sheet. It's a current here. It's in inventories. Yeah. Now, you too, if you continue to come to class every day, then you can say you are equal to the others in terms of grade. Last time you protested, but if you come to class regularly, yes, then you have a point. Okay.
Shit, I tried to apply, and they never hit me back up.
What, my job?
No, waiter.
What did you come up with?
21, 25.
Now that means how many times you get your inventory, you mark it up, you put it on the shelf, and you sell it.
You think
That's the more you do that, the better you are.
Coca-Cola be higher than that? 25.
Alright, which one we on now?
Inventory turnover.
Wait, my number right? I got 8.5.
Yeah, that's fine.
Inventory ratio.
Now you got to catch up on your own, Reverend. We can't sit there and wait for you.
Nah, I'm not.
Because you, okay, now we go to that.
My stomach hurt.
Now let's continue now with, we did the profitability, we did long-term solvency.
We gotta do the market strength ratio.
Oh, I think I am putting on the one that is not I sent you, the market strength. There's one more slide, market strength. Okay, why it's not showing up? Okay, let me go back to my email one more time. This is just a ratio analysis project. Tuesday. Okay. Sent items. Okay, inbox. Let me go to inbox. Ratio analysis project.
Bro, see you back at home
The last home game was like midway through the season.
and they play Kingston.
Oh, this is blowout.
Yeah. But I did the anyway. Let's add the slide. Let's add the slide. New slide. Okay, and then market strength. The new slide, market. Something is missing, really.
The price earnings ratio.
What does market strength mean?
How strong the market is, like, for your product. Like, how strong your product is in the market. Like, if it sells a lot, or like, if it has a lot.
What is the reputation of your business in the market? I mean, what you're saying is okay. Yeah? So if you're, like Apple, for example, Apple is really has a good market
I just thought
strength.
about that. Why I ain't pick Apple? I picked Walmart.
I just pick Coca-Cola.
See, what kind of cell phone you have? You see?
iPhone.
Apple. Mine is Apple. What's yours?
Android.
Apple.
Apple.
See,
Man, forget all y'all.
the majority are Apple. Yeah.
That's racist.
Anyway,
My screen
So
don't.
that is the reputation of the business in the market.
My screen don't crack.
That's what we talk about. And the ratio that we're going to use for that is PE ratio. Price earning ratio. Okay, and this is a PE ratio. You're going to define it first.
Paper route empire.
Define, and then PE ratio is equal to, okay, is equal to earnings per share,
Market price per share divided by earnings.
EPS. All right, yeah. Market price per share divided by,
Earnings per share.
okay, equal market price per share
Will it be on our cash flows? Probably will. Be on cash flows.
divided by EPS,
Earnings per share.
earnings per share. All right, so market price, you got to go online and figure out what's your market price per share. Yeah, go online now and figure out your market price per share.
Hold up, I gotta have it.
Yeah, go online. How you can use your cell phone? You have to open that.
Right, I'm being too unnecessary, huh?
Yeah.
Well, I'm trying to see if I got this thing before I go put up this phone.
Do it today. It's not that bad. You can find it easy. Just type it. Yeah, just type the name of the business and write down earnings per share. No, sorry, market price per share.
Yeah, she'll just pop up.
Yeah. What's yours? Yours is $52.36.
Oh, I ain't even finished typing mine and mine popped up. Ooh, this went up. Ooh, Walmart went up on the stock prices.
How much is it now?
$86.90. I remember, I think just last year it was just like $75 and like 80 something.
Ooh, imagine somebody has 100 shares.
Ooh,
How much you will earn?
I need to get my money up. That's why I'm glad I started work today. I'm going dumb. I'm going
Nah,
dumb. I need to go.
76.6.
Huh?
76.6.
All right, let's go ahead and do that. 76.6 divided by
Not 44.83.
I need to go get
earnings
me
per
something.
share.
I need
Now
to-
look in your income statement. You may already have your earnings per share.
You said mine. I had
Income
mine
per
said
share.
Earnings per share.
Whatever
Diluted.
diluted, yeah.
Not use the basic.
Alright.
Not dilute. Not dilute. Diluted.
Oh yeah.
Basic. Use the basic.
Okay.
Yeah. Whichever one you have available, use. Whether it's diluted or basic, whichever one you have, just do it. Yeah, you'll be fine.
Oh, they almost the same.
Yeah, you have the basic. Yeah, use
Okay.
the basic. Yeah.
Alright, this one says basic net income per share from continuing operations. 1.
And what else do you have? That's it.
Well, basic net income per share.
That's it.
29 cents. Or that's the,
Ooh, yeah.
is that the earnings per share?
Yes.
Okay. And the market price per share is 44.
The other
Oh,
way.
it just went up.
How am I
I
supposed to
got
find that?
26.
The earnings
Oh,
per
that
share?
yo, I
That's
just
on
hold on.
earnings per share.
Yeah,
Hold on.
look at your
Let me see if we
income
booming
statement.
like that. We booming like that, man. What's that warm up?
Nah, bro, we just went down.
Oh, shit, this one I got.
We just went down.
Oh, we just went down to 3 cents.
178,
Yeah, 1 cent.
Oh, that's some bullshit, bro. We went
Guys, if you don't have it,
Oh, we just went down to medicine.
if you don't have it, just divide your net income by total shares outstanding.
I got a lot to learn.
You don't have it yet.
Dang, mine went down to 82 cents already. Golly, man.
That's not bad. You 82
Oh, nah,
cents.
nah,
Yeah.
just, you
So
know,
we
I'm
put
practicing
the
my day
44.83,
trading.
that's how
Like
much
I'm
it is,
day trading.
44.
Okay, what did you get?
26
26. That's very good. What did you get?
I'm about to do it right now.
What did you get? 2.
Yeah, I got 176 point.
1.70.
I mean 178.1.
What did you get?
That's what I'm doing.
25.
Look for earnings.
Earnings per share. Look at the bottom of your income statement.
But how the
Per share there. Use the
44.83
basic one. Yeah. Use the basic one.
divided by?
Wait, I don't think it's 20 cents.
How am I getting 154?
Let me see what your numbers is.
44.83.
Divided by 0.29.
So here's what it means.
That's what I'm saying.
Okay, here's what it means.
I keep getting 154.
You are comparing.
I got that too.
You're comparing how much a share earns. You're comparing how much a share, one share earns you in relation to how much it's worth in the market. So if you came up with 26, that means you are willing to pay for this share 26 times as much as it earns. You're willing to pay for it 26 times as much as it earns. So that's probably a very valuable one. Has a good reputation. People are willing to pay much more than what it earns.
See, I'm
What did you get?
It keeps giving me 154. I'm doing
That's fine.
What? 44 divided by 0.29. You can give me 154.
That's fine. That means the people are willing, are desperate for that.
So
They are willing to pay 154 times for it as much as it's worth. Yeah. As much as it earns. Sorry. That's not too good.
but it's legit.
Doesn't sound right. Doesn't sound right. For Sonny, it doesn't sound right. Something is wrong.
Well, okay, I can see it because it's like this is $44.83.
No, then
This
it's
is
gonna
only
be worse.
29 cents.
Okay. What's your market value? 52. Okay, 52 divided by. Ooh, that is not good at all.
Okay, I see.
Strange. What's happening to? See, it was a negative, and then 58. Yeah, I think I got. Look one more time on the market price per share.
I don't think Goodrich doing
One more
good.
time. Look at one more time. That means it's not. It doesn't have a good reputation, Sonny. I'm surprised.
The Xbox one thing.
So it's still 52. Yeah, it's even less than
What does
one.
this mean?
Huh?
What that mean?
It means that people are not even. The market price is not even.
People invest in Microsoft. They want the Xbox instead of PS4.
People are not willing to. People are willing to pay for it less than what it earns. People are willing to pay for it less than what it earns. That's not. Doesn't have a good reputation yet. It's okay. The idea is that you practice. That's the idea. It's okay. You did the assignment. That's it. Yeah. And the idea is not whether it's good or bad. The idea is that you do it. Yeah. Yeah. That you practice. That's the idea. And guys, the final slide is the conclusion. Your final slide is the conclusion. And the conclusion, you write an overall summary. Okay? The conclusion is you write an overall summary about this business. Now, guys, should we use next week to do your presentation here?
Next week.
Bring it on you can email it to yourself, or you can have it on flash drive and present it there. Should we say next week, or you need one more time? More time.
Brian gonna bring us to the championship.
Oh. When is the last day of summer school?
We can do it. We got the next.
Huh? School is, guys, this one supposed to have started 26, you remember.
I thought it was supposed to start.
Can this be our final?
What's our number 26?
Nah, this supposed to start the 21st.
No, 26, I think.
Nah, cause we started the last week of summer one. That's when cause they had them in the chain. That's why it took people so long to get the schedule situated.
No, 26.
How did we coming up with this? How do you start summer 2 while summer 1?
Yeah, that's.
That was
It sounds illegal though.
Yeah, I'm with you on that one. It's not a matter of legal legality, no.
It has to be. Because those are two different sessions. That's like you starting the spring session in the middle of the fall session.
But that's why they are not too restricted on the time of submitting grade, yeah. So they are very relaxed about that, yeah.
So that's why Dr. Allen just put my grade in, even though I'm turning in my book first.
So that's probably still doing it maybe. Okay, so next week, let's do it guys, next week. So you think you can do your presentation by next week?
Wednesday,
Wednesday.
Thursday?
Let's do it next Thursday.
Alright.
Alright? I think we can do it in one session, yeah.
And does this school library be open on Saturday?
Yeah, Thursday is open, yeah. Friday, no classes, yeah.
Well, I'm talking Saturday, my only holiday.
Okay, and then guys, I'm gonna give you. I need the balance of the time. You're not going home yet. The balance of the time, I need at least chapter 13.
All right, hold
And
on.
14
We about to pop that out. We about to pop that out
right now.
Like right now. Let me just I gotta finish. we gonna be on the road. We gonna get 14 right after that. Like bam.
Okay, so don't leave yet. Do chapter 13.
I can do 16, the one you just gave.
16, you can do it.
Yeah, I mean,
We got the rules for you.
At least give me.
that's what I'm saying. I don't have,
Give me one chapter at least before you leave today.
Hold on,
That'd be fun. I'm gonna do 16. Go for it.
I
You just need to go back to the slides, maybe,
took this much notes.
or go to the. You need to put guys for you the PowerPoint on the board, or you get on Wilson phone. The PowerPoint. Can you get it?
on my phone?
Yeah.
Yeah.
Go to the my courses and see, and then they may help you a little bit when you answer your question.
Okay, now I'm debiting cash.
All right. While you guys are doing that, I'm gonna sit in my office and work on something.
Okay.
So you can. I mean, I'm gonna make an exam. I already have your exam, exam 1, and I'm going to post it.
Okay.
But I will give you guys a copy, okay?
Yes, sir.
Yeah, but not today. By Monday or Tuesday, by the grace of God, I will give you exam 1. But I need these assignments, guys.
Yes, sir.
All right. So we don't want to stay behind. So we already finished 4 chapters: 13, 14, 15, and 16. And then I think you're gonna like the chapters after that, guys. We're gonna start really managerial accounting.
I like account period.
On Monday, we will start managerial accounting. You're gonna like that. And we're gonna talk about costs, product costs, yeah, and cost terminology. And so you're gonna enjoy the rest of the
I'm
chapter.
about to be doing that over the weekend when I do the book. So how you?
You could say, guys, from chapter 1
Manager.
in accounting 1
Like costs and stuff like that.
until today, chapter 1 until today, that's financial accounting.
Yeah.
But this one, chapter 16, and the cash flows, you could use 16 is both financial and managerial. The cash flows is also both financial and managerial accounting. But starting next week is all pure managerial accounting. See, from chapter 1 through 13, in other schools, you have to do it on your own. I mean, they come to class, they give you one lecture and then they leave. Give you a lecture and then leave. That's financial accounting. So accounting 1, we use accounting 1, they use financial accounting. And then accounting 2, they use managerial accounting title, we still use accounting 2. Yeah. Yes, sir.
Hey, so, quick question. The current ratio,
One of these. Yeah.
everybody else doing 13 and 14.
Yeah, you got to, that's your, don't ask me about those. That's a sneaky question.
But this a test or something?
Brother Libera, you got to do it on your own. Okay?
So you're saying I can ask for help?
You can if you. Hi, Doc.
You didn't even help me.
You got to do that on your own. See, you're not even looking at any material.
It said current ratio.
I mean, where does it say?
It said current ratio.
Where? You're not even on the side.
You were saying too long. Like, it's the only one I have. So I started with LG.
Go to,
So I gotta do it like
to
this?
your chapter 16 on Jigs. Go to Jigs.
That's what I'm saying.
Coursework.
Chapter 13, just because it's gonna help.
Huh?
Never mind.
Yeah,
Chapter
go
13.
to
credit the treasury
PowerPoint.
Yeah, for 60,000.
Brother Ledbetter.
That's
Go
what
to
you
the
gotta get that
PowerPoint.
amount, right?
Not this one.
The additional PIT is gonna be 900.
Not the presentation. Go to the chapter 16 under coursework. PowerPoint.
Yeah.
Yeah.
So it's really gonna be 8 of them.
Let me just stop broadcasting.